Welcome to our webinar today. We can give just a few more minutes to finish letting people join. Okay, so we'll go ahead and get started, and I'll begin by just simply introducing myself. My background, as a CPA, I obtained a master's in accounting from Vanderbilt here in Nashville, and then began my career with Ernst & Young in the assurance practice here in Nashville as well. And after that, I moved to Genesco, a public retail holding company over by the airport here in Nashville as well. And I spent about 3 years in internal audit and then a final year in a managerial accounting position, specifically with the Johnston Murphy brand. So, after that, I started adjunct teaching with Lipscomb and then began my career in academia about 3 years ago. So, now I teach here at Lipscomb. I'm beginning my 4th year as an instructor. In the past, I've taught financial and managerial accounting courses, and then beginning this year and moving forward, I'm thrilled to begin teaching accounting information systems and data analytics courses as well. So, one thing that's enabling me that transition is the completion of my doctorate, which I'm currently working on committee comments for the dissertation proposal, and that will be coming up this fall. But my research, historically up till now has been presenting at conferences. I do have, one publication in a contemporary tax journal. You can check that out. But the synthesis of my research really lies in IT governance, cybersecurity, corporate social responsibility, and then, of course, data analytics. So that's my introduction, and I'm thrilled to get to speak with you all today about the importance of analytics in accounting. So, as you saw on the promotional material, the session overview for today just basically says, obviously we're living in times of dramatic change, and as a result, the priorities, resources, and processes within our organizations have each shifted. So, from an accounting perspective, this really means that efficiency, security, and innovation are of utmost importance. So throughout our webinar today, we're going to discuss how the usage of analytics and also, and perhaps most importantly, emerging technology is going to enable us as a profession to quickly meet these challenges of the new economy that we're facing. So, I want you all to understand that the material that we're discussing today will come from published accounting research as well as information published from the Big Four accounting firms, and then a little bit of accounting textbook curriculum. So we'll talk more about that in just a minute. Here's an overview of our agenda for the day. We'll begin with a very basic foundation of analytics within accounting. So we're going to assume, as I present this webinar, I'm going to assume that this webinar is reaching an audience on a very wide spectrum of knowledge as it pertains to analytics usage within the accounting profession. And that's going to mean that I'll start this webinar with a presentation to give us all a bit of a baseline so that we can have a really robust dialogue by the end. So we'll start with that. At the College of Business here at Lipscomb, our perspective to teaching analytics, specifically within the accounting curriculum, is driven by what we hear from largely the Big Four accounting firms. So, I want to reference a couple of these quotes from their pronouncements. The EY Foundation in 2016 said, the big idea of the analytics curriculum is the need for accountants to develop critical thinking skills using data and to practice discovering and communicating these meaningful patterns in data using emerging and evolving technologies. So you want to pay close attention to that meaningful patterns. That's one of the most significant driving forces to approaching analytics. And then lastly, PwC's 2018 Developing Digital Acumen stated that essential technology capabilities include data wrangling, data insights, and data visualization, whereas this data visualization is the ability to be able to not only understand, obtain, manipulate, and analyze, but also communicate this data and information by representing it as a picture or leveraging visual objects such as charts or interactive data models and other illustrations. So not only do we have to teach our students how to think and analyze this data and identify these appropriate patterns, we also have to teach them how to present the data and their conclusions in a visual form that is easily understandable and can be communicated across organizations. So we will continue on to talk about this analytics mindset. So this term analytics mindset is also something that was driven from the EMY Foundation's 2016 pronouncement. And it basically just states that there are certain characteristics we need to instill in our students, but that translates to the same characteristics that we need the accounting profession to adopt as professionals as well. So as much as this is relevant to our students here at Lipscomb, it's relevant to all of us as certified public accountants in a evolving and changing workforce. So these characteristics, the first, use critical thinking about data to answer questions. So if we are going to apply that, we'd say, well, how do you best estimate bad debts? You know, perhaps there's information we can incorporate outside of traditional accounting data to help us make that decision, particularly now in light of this current pandemic, right? A second characteristic is to engage in continuous and self-motivated learning to acquire new data analytics models and tools. So we have to focus really strongly on empowering our students to learn a new tool as new technologies emerge. So these nuts and bolts of accounting or of analytics are quite similar, but the technical ability and power of the technology is going to continue to evolve. So our students and us as professionals, right, as CPAs, we have to have this confidence to be able to self-teach ourselves these new technologies as they become even more important to stay relevant in our profession. And then the third characteristic of the analytics mindset is to develop a design thinking mindset that's focused on finding solutions to ill-defined and complex problems. So, you know, here at Lipscomb, a strong foundation in accounting theory and lots of focus on application is really important, particularly in light of COVID-19 pandemic. We have been presented with more opportunity to bring these ill-defined and complex problems into our instruction as a faculty than we ever thought possible. And I'm sure you can absolutely relate to that as well in your profession, so, or in your position at your firm. All right, so we're going to start, you know, in order to join this conversation on analytics, it's really important to understand the 4 types or classifications of analytics. So that's going to be descriptive, diagnostic, predictive, and prescriptive. So some of these you may already be doing on a regular basis, particularly descriptive analytics, where we're basically summarizing activity or mastering data on specific attributes. Diagnostic analytics are where we begin to pick up on this analytic mindset, right? So this is where we're identifying correlations or patterns between the variables or data points that we're analyzing. And then lastly, predictive and prescriptive analytics are the steps where we can begin to really significantly add value to our profession and in your current position. You know, this is these tools where we're discovering these hidden patterns that are linked to abnormal behavior, particularly as accountants, we care a great deal about that. And then the prescriptive analytics, where we're going to be able to actually make recommendations for the future and future operating decisions based on past historical data. That's where we're able to solve those ill-defined and complex problems that we just discussed. So now we're going to begin just a little discussion and talk about how we can apply within an accounting context each of these types of analytics. You know, we'll begin with the descriptive analytics, and these are the types of analytic tasks that you are likely already doing on a continual basis in your position. So, you know, for example, an age analysis where we're looking at groups of balances by date rings a strong bell with those of you in a corporate accounting position when you're reviewing an AR aging, right? We can sort, identify largest and smallest values, look at the summary statistics, mean, median, max, count, mode, etc. You know, a lot of journal entry testing is going to involve sorting, and then these summary specifics can be used to compare lots of sets of repetitive transactions and etc. So again, these are types of analytic processes that you are likely already including and completing in your roles. We'll move on to diagnostic analytics. So we want to remember that these diagnostic analytics are looking for those patterns and correlations within data, right? So for example, if we utilize the Z-score, we could do that to perform outlier detection if we're looking at a population of transactions. We could also use Benford's law to identify unusual transactions or user activity that's based on the distribution of first digits of that activity. And then, you know, clustering analysis, that's an excellent way to be able to determine non-obvious groupings. And then we can take those non-obvious groupings, you know, that we wouldn't identify if we were looking at a flat Excel spreadsheet, but we import that into a data analytic tool and employ a cluster analysis. And we can see how these patterns or profiles of data points can help us predict the likelihood of future subsequent outcomes. So, you know, a lot of these types of analytics, including the exact and fuzzy matching, the sequence check, stratification, these are things that could fall into what organizations would refer to as continuous auditing or continuous monitoring, depending on your particular function within your organization. The next type of analytics are called predictive analytics. So they're used to predict the likelihood of future outcomes based on a set of observed data points, right? So it's important to note that with predictive analytics, in addition to the quantitative data, traditional accounting data that we've discussed use of in the previous two types of analytics, we can now begin to incorporate binomial data points, so a yes or a no, categorical data points, high, medium, low, where we're either ranking or classifying various data points, and then also qualitative data. And that will allow us to complete this sentiment analysis, which we'll discuss here in a minute. And these we refer to as more advanced analytic functions. So, you know, in terms of just an overall difference between the previous two types of analytics and then predictive and prescriptive analytics, the second tier, they're going to provide less deterministic output and more probabilistic models, right? We're going to be able to judge things like the likelihood and the probability of a future event occurring. Specifically, you know, regression analysis is going to allow an accountant to predict a specific dependent value based on a certain set of independent variable inputs, right? So as accountants, this can be incredibly helpful in terms of budgeting and cost analysis. Classification is somewhat like a second step in cluster analysis where, you know, as accountants, we could absolutely use this and utilize this tool in some type of a risk assessment, right? So you could predict classes of risk, low, medium, high, etc. And when we're talking about classification, the strength of that class can be really important to us as the accountant, particularly, or an auditor, particularly as you're trying to determine the scope of an audit test or procedure, right? Then we can talk a little bit about sentiment analysis. So sentiment analysis is going to enable the evaluation of a text. So for accountants, this could be evaluating elements of the annual report, management's discussion and analysis, press release or earnings release, emails throughout your organization from an internal audit perspective. We're going to be able to evaluate this qualitative data for distributions of words that can be classified as either positive or negative in terms of tone or sentiment, and that can then be, you know, directly linked to positive or negative outcomes, and we can look for potential bias that's built into the varying types of sentiment that's used. There's a lot of empirically validated dictionaries, so dictionaries that have been used and tested in academic research that you can use in your positions as, you know, CPA to categorize words depending on, no matter what you're looking at, but the dictionaries are fine-tuned to be able to complete this sentiment analysis within a financial perspective, right? So we know that words mean and can carry different implications in terms of sentiment or tone relative to the context that they're presented. So if that's something that you're interested in, I'm happy to talk to you more about that, and I can get you the related articles for more information there. All right, so we'll go ahead and we'll talk about the last type of analytics, and these are prescriptive analytics. So we'll call this applied statistics, and it includes additional mixed distributions or non-traditional statistics that can also provide insight to the auditor, okay? Largely when we're talking about prescriptive analytics, we're talking about some form of artificial intelligence, where we're going to model expected behavior by evaluating past actions that have been taken by management, auditors, etc., in order to predict expected behavior in a case that's unknown, right? And we'll talk a lot more about this artificial intelligence here in coming sections. So with that, I want to open up for a poll question. Our question right now is, what level of analytics have you seen integrated into your current position or within your firm? And we'll give a couple minutes to, or maybe just 1 minute to get a few responses there. And I hope that you've been able to perhaps realize that throughout this discussion, analytics isn't really such a foreign concept, and that you can directly see how throughout the 4 different types or classifications of analytics, you're either already incorporating them, you've heard discussion, you know of others within your organization that are doing these same things, and it can empower you to have a more confident conversation about those. So I think our results are coming. Let's see, it looks like we have a really good spread here. The predictive analytics are just the first 3 levels of analytics is, you know, what received the lowest population, but I would say, you know, the majority of us are sticking to that descriptive and diagnostic level of analytics. And honestly, we'll talk more here in a little bit about some recent research that studied the usage of more particularly artificial intelligence within the profession and how that's being used, but that is actually in line with what their research study showed as well. So we'll talk more about that in a second, but that's good to know. All right, so the next step or the next component to analytics within accounting is understanding not just the various types of analytics, but then what's referred to as data modeling, okay? There are 2 respective approaches to consider when you're approaching a data analysis project. An unsupervised approach is used when you do not have a specific question. So an example here is, do our vendors form natural groups, right, based on similar attributes? On the other side, a supervised approach is used when you are trying to predict a future outcome based on historical data. So our example here is, will a new vendor ship a large order on time or not, right? So that's that probability, yes or no, or likelihood. You could also hear these referred to as either exploratory or confirmatory analysis. So types of unsupervised approaches include clustering, which you could have recognized from that example question that I just gave, where we're looking to find undiscovered natural groupings in the data. Co-occurrence grouping, so where we're just looking at events that happen together, whether that's obvious or not obvious, without an analytics tool to help us visualize that. Profiling, where we're identifying typical behavior within groups of individuals, and that perhaps that profiling makes me think of an internal audit procedure where you're looking at auditing the T&E reports, and you should expect to see different profiles for different levels of employees based on their activity, right? So you could run your data through a profiling analytics and be able to assess based on the different types of behavior that you observe, and whether the individual related to that data point falls in the appropriate profile or not. And lastly, data reduction, where we're going to filter the group of the data to basically simplify your analysis. So these are unsupervised approaches. On the other side, we have supervised approaches, where this would be that second step of cluster analysis, where now we're going to actually use classification and predict whether this data belongs to one class or another. We're going to use similarity matching, where we're grouping data by attributes, regression analysis, which would perhaps be the most familiar of these analytic terms that skills that we're talking about so far. We're using historic data to predict a specific value in the future. And then link prediction, which we can use in social networks or social network data, and then causal modeling where we're looking at how one event happens to influence another, right? So let's open up for one more poll. And the question now is, in your role, have you been in charge of completing or auditing any process dependent on supervised or unsupervised learning? So the options here were no, yes, supervised, yes, unsupervised, or yes to both types of analytic approaches. So I'm really interested to hear, as most of these apply to the predictive or prescriptive types of analytics, which the majority of you said that you're not seeing used in your organizations or in your current role. I'll be interested to see what our smaller proportion of participants do observe when we're looking at supervised to unsupervised approaches. So a majority said no, right? Yes to both. So I'm going to assume that if you were in that group of the final category where you're using all four types of analytics, then you're using both supervised and unsupervised. That's what this poll at least tells me, and that's interesting. It's great. All right, so with that, I'm going to assume that we all have a little bit of a baseline now when we talk about analytics and accounting, that we're familiar, or we have a foundational knowledge to be able to continue the conversation. And with that, I want to give you just a quick insight into the different tools that you can use to incorporate these analytics. On the left-hand side, we have analytics tools. On the right-hand side, we have ETL tools. And if you haven't heard the term ETL, when you do hear that, we're referring to the process of extracting, transforming, and loading the data, right? So we've been talking about using these analytics to manipulate and understand data, but where did the data come from? Well, it's these ETL tools that help us extract this data, clean the data, work with the data to be able to get it to a usable point that we can then load it into these analytic tools on the left-hand side and apply analytics and come up with meaningful correlations and patterns. So, you can see in this chart here, this was a chart that was published by Gardner in 2017. Maybe you need to zoom in on your screen. I don't know if you can, but we're looking at the completeness of the vision. So a lot of these tools are going to help us actually not just apply the analytics, but visualize the outputs, right? So the completeness of vision is on this scale, and then the ability to actually execute those is here on the y-axis. And the three that really stand out most are Tableau, Kulik, and Microsoft. Okay, Microsoft, we're talking about not only Excel, which can do a lot of those diagnostic and descriptive analytics, but Microsoft Power BI is as well. And if you understand Excel, Power BI is really not too difficult to work with. Tableau is perhaps the most user-friendly analytics tool, and they have a lot of trainings online available for you, as you could find with each of these. I'm going to copy and paste if I can. It doesn't look like I can. I'll send, maybe perhaps at the end, there's a really good article in the Journal of Accountancy that came out in March of 2020 where two Stanford University and Birmingham, Alabama accounting faculty are comparing the differences between Excel and Tableau, and particularly in light of CPAs. They give a really great example of how to use Tableau for an accounting analytics question. I really recommend reading that article. You should be able to search for it and find that fairly easily. So with that, which analytics tool, we'll open up for another poll question. Which analytics tool are you most comfortable utilizing outside of Excel? Because I'm gonna make a blanket assumption that as CPAs in 2020, we feel really good about Excel. So our options here are Power BI, Tableau, SAP, R, which is actually an open source analytics tool, but it could be used for the ETL process, all types of analytics. Obviously there are issues with confidential data, but in general, there's a lot of application there. And then another tool called Alteryx. So really interested to see which systems or programs you're using. Tableau, awesome. That is the 57% that use Tableau is not surprising, given its extreme user-friendly ability. However, I am a little shocked that more of us aren't using Power BI. All right, so we can go on. Now we're going to talk about, this is probably why you signed up for this seminar, the application of analytics in a pre and post COVID-19 world, right? So I chose to address internal controls in this portion of the webinar. They escape no one, right? For external or internal audit, tax and managerial accounting positions, the impact of having sound internal control, design, operation, monitoring, or auditing, that's not going to escape any of us. So with that, the question that I want to pose is, internal controls matter more now than ever, right? Particularly in a time that feels quite out of control. So why is this? First, I'd say it's processes have been forced to change with these mandates for work from home. Now, if we're talking about analytics and how we can use these to address these new outcomes or unique situations, our systems, right, they can be audited from a distance much easier than that physical human interaction. So automation with various analytic tasks and then building a related dashboard for continuous monitoring of these processes, it's going to be really, really relevant as we go forward. The second answer here was limitation of resources. It's going to lead to an increased need for trust, right? So that increased trust, it can be delivered via secure, complete population testing, which we can do with analytics as opposed to our traditional sampling techniques. And also we can use continuous monitoring here, right? So in the middle of so many of these circumstances that are out of our company's control, our shareholders and investors, they really need to have the utmost certainty that our significant operating processes are not being overlooked. And our internal controls are really how we can deliver that assurance, right? And then lastly, professional skepticism is more important than ever. So, in our world that's been completely turned upside down, with any sudden significant change, there's going to be an increase in an opportunity for fraud. Also, our historic patterns that we could observe, they might not hold true, in particular for transactional considerations or employee actions. So the usage of these diagnostic analytics to, as quickly as possible, identify these changes is really imperative. Perhaps, evaluating credit is not as simple as it used to be. So analytics will enable us to make these swift changes based on relevant data and really improve and solidify the validity of our internal control processes. All right, so with that, I have another poll question for you. Out of the 3 reasons listed on this slide, why, in reference to why internal controls are vital in the middle of this current pandemic, which resonates the strongest with you? Is it the change in processes due to differing work locations? Is it the limitation of resources and you feel the pressure of this increased need for trust? Or do you recognize that professional skepticism really does matter more than ever at this time? Interested to see what we have to say about this. Here come the results. So 56% felt that processes have been forced to change and limitation of resources hasn't been observed, but professional skepticism is more important than ever. Excellent. Interesting results, but these are great. Thank you. So with that, we're going to move on from talking about analytics to emerging technologies. I personally am going to propose that analytics are on the verge of an imperative component to nearly every CPA position in the immediate future or the very coming future. I believe most that emerging technologies are what is going to really bring the most transformation to our profession. So, you know, in light of the current pandemic, I think that transformation is going to come a lot sooner than it would have otherwise. But that agility that's going to be necessary and the adaptability for us as a profession, it's something we're going to talk about here in just a second. So emerging technology within accounting, it's typically divided into three categories. We have analytics, which we talked about, blockchain technology, which this seminar is not going to address, and then lastly, artificial intelligence. Artificial intelligence is typically divided between two subsets. We have first machine learning, and that can involve a lot of the elements of analytics that we just discussed, as well as robotic process automation. So we will define, describe, and give you a little bit of an example of application for each of these types of artificial intelligence in the slides to follow. So artificial intelligence, what do we mean? Well, you know, scholars refer to this as anything from automating simple tasks to handling complex thinking assignments. You know, accounting data's main function is to inform managers about firms' financial position, risks, and opportunities, okay? So under this AI, artificial intelligence umbrella, machine learning and RPA, which is what we'll refer to as robotic process automation, they absolutely serve that purpose. You know, things that should be considered through business lens, when we're talking about artificial intelligence, we need to not just think of it as a technology, but through three important business needs. And those are automating business practices, gaining insight through data analytics, and engaging with customers and employees. All right. Now, it's really important to note that artificial intelligence is obviously important in the context of augmenting the intelligence of humans, right? And in the support of better decision making. However, there is ample opportunity for bias and ethical concerns to influence the uses of this artificial intelligence. If you would like to read more about what scholars are saying related to that aspect of incorporating these emerging technologies, I highly encourage you to do that, and I can provide links to some really, really good current research along those lines. All right, so the first subset of artificial intelligence that we're going to talk about is machine learning, right? So machine learning is defined as a computational method that learns patterns from large and complex data, enabling predictions for future events, right? It's responsible for inductive reasoning versus a deductive reasoning approach. And the graphic in this slide is basically going to just show us that, you know, historically we use this deductive reasoning approach where we built theory. From the theory, we proposed our hypotheses. Then we went out and gathered data that's relevant to answering these questions and use that data to then test our hypotheses. Whereas now, through machine learning and applied data analytics, we can take a myriad of data sources. These can be structured data sources like accounting data, and unstructured. It comes from, you know, text, visual data, data from the Internet of Things, social media, etc., right? We can take a myriad of data sources, we can combine them, and the first step is selecting which data is relevant to the question that we're interested in asking. We apply it to a machine learning. And what's important and significant about this inductive approach is that once we get this data selection, we'll divide it between a training data set that we use to build our model through machine learning. And then once our analytic tool has selected the very best model, we will go back and validate that model with a subset of that initial population of data from the beginning, and we'll test the model again to validate the conclusions and outcomes that we found, or predictive model that we've derived from this machine learning tool. Okay, so a significant change in the way that we do research, but also the way that we answer questions in industry. More about machine learning. So different types of application here, where we can recognize patterns through extracting features and then subsequent classification or clustering, right? Natural language processing for that sentiment extraction, deep learning or building a neural network, right, to search through data, detect specific characteristics, and then cluster that visual data. And then the fourth type of application that's listed here is predicting, is the specific predicting power from processes of training and testing that data. So that's what we just talked about. Examples of this application, at least within Big Four firms, if we're talking within an audit context, this could include pulling essential information from lease contracts or assistance in analytical procedures surrounding sales revenue, that's going to help to predict trends by analyzing some key indicators. We can use machine learning to help us do that. From a tax perspective, you can use this machine learning to inspect employee expense reports in order to make deduction determinations or determine the classification type for tax purposes. In terms of the types of data that we can use, again, what's significant about machine learning and what really gives us a competitive advantage here when we employ these is that we can use unstructured data, right? Handwritten data, scanned images, voice data, all of these things can be included within a machine learning tool to help us quickly solve a problem that is almost impossible without the technology. So, as a predictive tool, it's going to allow us to support judgments and decision-making processes. In addition, these machine learning tools can significantly improve the accuracy of our accounting estimates, right? Particularly, machine learning has been found to assist in predicting fraud, bankruptcy, material misstatement, and even audit quality. So next, we're going to talk about robotic process automation. This is defined as software robots that offer improved business efficiency, data security, and effectiveness by mimicking human actions and automating repetitive tasks across multiple business applications. What's referred to as RPA has the potential to significantly reduce the requirement for employees to perform. This is where this is the key phrase that you should link to RPA: rule-based, high-volume activities. Okay, I was at an academic conference in January where we heard from the president or chief accounting officer, I believe, of Darden Restaurants in Orlando, Florida, who talked about the ability to finance the expansion of large acquisition of restaurants by employing RPA in their accounting processes. They were able to acquire 1,500 restaurants, something around that number, and increase their accounting workforce by maybe 1 or 2 people, with the extreme investment on the front end of this robotic process automation, right? They took a risk, but for them it paid off. So, examples of RPA technologies in audit, you can use an RPA technology or a bot, as you might hear it referred to. You can program that to input the purchase order, the invoice, shipping information into an audit testing documentation form, and then it can analyze that form and automatically notify the auditor of a discrepancy, right? In terms of tax, you could use a bot to automatically calculate book or tax differences. apply the difference to the trial balance, evaluate options for the treatment of discrete code or transactions, and potentially even calculate state apportionments and adjustments to complete and review the tax return workbooks. So these are the types of things that, at least with the Big Four, they're experimenting with and already employing. So we're going to talk a little bit now about the concerns related to this RPA technology. So while our current research, and again, this current research that I'm referencing today comes from a journal that we'll talk about here in a second, the Journal of Emerging Technologies in Accounting. It's a AAA journal. It's really excellent. It is extremely high quality academic research, but also very applicable for practitioners. So I wanted to give you all a little bit of insight into, what's being done here, the work that's being done, and how you can take that and apply that in your careers or in your positions at your firms. One piece in a recent publication, I think it's spring 2020, they are exploring the impact of psychological capital on the usage of RPA, right? Their proposition is that a higher level of psychological capital is associated with higher levels of readiness and then subsequent reliance on RPA. So, in particular, this article is going to encourage CPAs to discourage an over-reliance without a very sufficient level of assurance. And depending on the psychological capital of the auditor or the accountant employing this technology, that the level of that assurance that's needed it can vary. So it's a really interesting article. And then, a second study is going to propose business process reengineering, which is a term you might hear. That's referring to what we're just talking about, the automation of all of these processes, right? The default position of BPR would be to eliminate labor, right? The study that I'm referencing, it suggests complement that BPR with business process de-engineering, right? So along with automating where automation adds value, also consider adding a human and how that added human would add value to what would have been a predominantly automated process. So another really great article there. Obviously, both are highlighting the importance of professional skepticism, which 46% of you, a few slides back, noted as one of the things that you observe in this post or mid-COVID world that we're living in. And if you want to learn a little bit more about professional skepticism, I believe that Perry Moore and Kevin Monroe had a really great webinar about that a few weeks ago that you could reference. So, in terms of artificial intelligence in public accounting, who is actually using this technology? In another article published in the Journal of Emerging Technologies in Accounting, scholars are surveying specifically public accountants or individual CPAs in public accounting with regards to usage of both of these types of AI, right? So machine learning and RPA. The findings of that article suggest that both are not extensively used yet by public accountants or firms, that CPAs believe artificial intelligence will significantly impact their responsibilities in 5 years. Now, keep in mind, these surveys were likely administered prior to the true outfall of the COVID-19 pandemic. So these results, I believe, might be a little bit skewed now, and that timeline is probably closer on the horizon than they previously predicted. 3, firm size is the strongest differentiating factor in the responses. Whereas if you were a member of a Big Four accounting firm, the employees would report higher expertise and greater utilization, specifically in reference to RPA, than those surveyed that were not employed by Big Four. They're also provided more training in artificial intelligence, as well as their clients are more likely to also be involving some type of artificial intelligence. And that does make sense in terms of the utilization of resources. But I want to challenge you, if that's not the position you find yourself in, think about, in these times of dramatic change, if you were to put forth, the effort and a little bit of the investment to incorporate these technologies into your firm, how many more opportunities would that allow you? And in terms of expansion and acquisition, as you know, industries are shifting and the climate is rapidly changing. What could this afford your firm, your organization, with a little investment on the front end, right? And then lastly, if your firm is not incorporating at least some type of AI, the scholars in this study propose that you will quickly find you're at a competitive disadvantage in today's rapidly evolving market. So with that, I'll ask, I think we have 2 more poll questions, but we'll start with our second to last poll. Which form of artificial intelligence are you more likely to attempt adopting in your day-to-day operations? I could make a solid guess about where we'll land here, but I do look forward to hearing your feedback. RPA, not at all what I was thinking you would say, so that's excellent, really interesting to know. Great. So again, I've referenced many times research from the Journal of Emerging Technologies in Accounting. It's published by the American Accounting Association. The editor is Nicholas Vasarely at Rutgers State University of New Jersey. He's a prolific academic as it relates to all things emerging technology, specifically related to audit, but not exclusive. Everything that's published in this journal is something that, as a practitioner, it could add value. 2 articles I wanted to point out specifically that are incredibly informative for you as a practitioner. The first article is going to describe in detail the process for building automated clustering algorithms designed to detect fraud. All right, so this means that the clustering algorithm that this paper will walk you through the theoretical foundations and step-by-step why these are the next steps in building this clustering algorithm. It's an automated algorithm, right? Whereas you build it once and you continue to feed it new data, it will continue to improve and become more proficient at its final prediction, right? So the effort of building this tool is largely exerted once on the front end, and then you benefit from having invested that in time periods to come, as long as your process is relevant, right? And then the second article, it's going to prescribe an integration of that RPA technology within the audit specifically, but it also provides a step-by-step demonstration of how to actually build and apply a very elementary level bot into a basic accounting task. So not only does she provide the theory and the why and some really, really great prescription for incorporating RPA technology within the audit, the practical step-by-step instruction at the end of the article is really excellent. So, you know, as somewhat of a non-traditional accounting faculty who came directly from experience in industry, I can personally attest to this theorized disconnect between practice and academia. But I really feel strongly about pointing you in the direction of this journal. And if you have questions about that or would like to know more about how to apply that research, please let me know. So this is going to be our last poll question, I believe. Have you heard of this journal prior to today's webinar? Well, it's been worth your hour. All right, 90% of you said no, 1% said yes. All right, so with that, we're just going to end today's seminar with a discussion of agile and adaptive accountants. The AACSB has really encouraged us as faculty in College of Business to push for agile and adaptive accountants in order to stay relevant and to continue the profession not as a compliance exercise, but really as a value add component of our organizations. Task automation has and will continue to lead for lead to a need for professionals that have both analytical and technical skills as it relates to data analysis, right? The skill set is going to enable us as accountants, not just students, particularly, you know, our Lipscomb students who are phenomenal and biased, but also those of us that are currently in the profession that are learning alongside them in a lot of ways. You know, the goal is the ability to pose relevant questions, to locate and analyze data, and then to present the conclusion of your analysis, right? We're going to be able to utilize data analytics and artificial intelligence to really economize or transform our profession into a truly value-added component of our organizations by economizing on time, information, and then managerial attention. And, you know, one other component of, excuse me, of that agile accountant is understanding the difference between the different types of analytic software, the question that you're asking, and then also AI technology, right? So we have to understand the theory behind analytics, different components, different tools that are expense, and then the different types of ways we can employ that artificial intelligence. So with that, if you have questions, this is my email address. You can find me online or email me here. I believe my office number is also listed if you'd like to give me a call. As a faculty, you know, if you have questions, email that to us, or me specifically, but as a faculty, we'll do our best to really thoroughly address the questions that you have. And I wanted to take this time to let you all know that at the College of Business, we've recently completed construction on a data analytics lab here in the College of Business. And we're going to utilize that this fall and in the coming years to continue incorporating these analytics skills and application that's infused across all of our courses in the College of Business. But specific to accounting, excuse me, we have a fantastic group of scholars in both the undergraduate and graduate master's level accounting programs who would really love to put their knowledge of accounting analytics and emerging technology to use using your real world data and solving real world problems, right? So if any of that is something that is of interest to you, you know, we'd love to hear from you. Thank you for participating today. Here's a list of references, but if you want more of the information about the different papers that we've cited today, or journals that I've referenced, or articles, please reach out. Thank you for your time.